Hello and welcome to the AIM Summit webinar series. I'm your host, Zachary Sefaradi, CEO and founder of Down Capital. Very excited to have this session today, which is going to be focusing on the GCC markets, investment themes, and market dynamics in the time of COVID. This session is sponsored by SICO in Bahrain. We have an excellent audience of participants today. I'm looking through and seeing people joining us, some names that we know very well, coming from all over the world. We have participants from over 30 different countries. Amongst you are family offices, institutional investors, high net worth individuals, leaders of some of the leading firms in the financial industry. So it's such a pleasure to have you all with us today. We'll be beginning our discussion today with the 10-minute keynote by Najla Shirawi, the Chief Executive Officer at SICO, followed by a 30-minute presentation by Nishit, Lakhotia, the Head of Research at SICO. After this, we'll have a 20-minute Q&A session, but feel free to submit your Q&A, submit your questions as they come. Don't hold back. We will be addressing as many of the questions as we can at the end of the session. If you are joining us on YouTube, please like this video and subscribe to our YouTube channel now. Without further ado, it's my pleasure to introduce the sponsor of this event, which is SICO. SICO is a leading regional investment bank offering a comprehensive suite of financial solutions and services, including asset management, brokerage services, investment banking, market making, advisory, treasury, and custody, as well as fund administration. The firm is backed by a robust and experienced research team that provides regional insight and analysis of more than 80% of the region's major equities. They have won multiple Euromoney's awards, including Best Investment Bank in Bahrain for the second year in a row, and they are the #1 broker in Bahrain for the last 21 years. Najla, the CEO, will be leading our discussion today with a brief keynote. She has been at the firm as the CEO since 2014, following a career with the bank that began in 1997. She's a board member of the Bahrain Economic Board and the chairperson of the board of directors for 2 SICO subsidiaries, SICO Fund Services Company and in Bahrain, as well as SICO Financial Brokerage in Abu Dhabi. She is an independent board member of Eskan Bank, the Deposit Protection Scheme, and the Bahrain Institute of Banking and Finance. Najla, it's such a pleasure to have you with us today. Please tell us, we've been looking forward to understanding how have asset managers navigated this crisis?
Thank you, Zachary, for the introduction. Thank you for all the participants joining us today. I really appreciate that you took time off your busy schedules to listen to us. Basically, Zachary, I'm sure that most of the participants are aware that the asset management industry, like any other industry, has struggled with a global pandemic, economic shutdown, as well as a crash of oil prices. Together with that, we faced in this region a different mix of government policies, from stimulus to support private sector, to some austerity measures to reduce the deficits caused by the crash of oil prices. Of course, this has had an immense, I think, pressure on asset managers in the region. Especially that those that have their fees pegged to AUMs have seen their AUMs falling because of a market sell-off, coupled with some outflows, as naturally clients were reassessing their asset allocation. They were looking at which asset class to be in. So some managers were winners with inflows, and some were losers with significant outflows. However, even those who have won certain new mandates were not able to net off the impact from market declines. Not only that, a lot of the asset managers have came out of 2019 very optimistic. So they had mandates in the pipeline, which mostly deferred. They had products planned to be launched this year. Most probably they are postponed till end of this year or even next year. So asset management as an industry, I think so far navigated well. However, those who have navigated well are those who run an agile, resilient, and stable business model. Those who have entered into this crisis were with very small AUMs, a very small capital base. Of course, they are challenged. However, let's look forward how investors would assess and evaluate in their selection process of asset managers the different players in the market. I think there are key points that will be considered. One is how the asset manager adapted quickly to change. We all prioritize safety and health of our staff. However, to do that, we had to send our staff home. So working from home became a new operational model. And this operational model only works well if you have a robust control functions and a robust risk functions. And those asset managers who have done well during the shift from an on-site to working from home model, I think will stand out. Those who have communicated clearly with their clients and were very transparent in terms of reaffirming the client objective amid the sell-off of the market, as well as being very transparent with their strategies, will be well appreciated going forward. If we look at what other points that would differentiate asset managers, it would be how quickly they responded to their clients' needs. Asset management industry is not in a silo and so on. It's part of the economy as a whole, and also the clients. So clients came into this, I think, crisis with different needs in terms of liquidity needs, in terms of lowering the volatility that they can absorb, and in terms of demanding true alpha from their managers. So those who were able to deliver that to the clients, I think will be beneficiary once the dust settles and we are out of this crisis. Also, these managers that have solid equity base as well as a prudent balance sheet management were able to focus on their core fiduciary responsibility, which is managing the client's assets, instead of trying to firefight internal issues, which is just firm related. One very, I think, key point that I need to highlight that short-term priorities may change. However, the long-term objective will remain the same. So asset managers who want to come out of this crisis as winners, they need to be on the offense rather than the defense. And why is that? Because there are a lot of opportunities in the market as the market goes through structural change. Asset managers should think of their product mix, maybe switching from a single product to a diverse mix of products, adding new strategies, looking into providing clients with solutions rather than just running a rigid business model. One, I think, key also development after any crisis is the need to consolidate in any industry. So the stronger will be able to get bigger, get stronger by acquiring smaller players. So consolidation in asset management is very important, especially in our region. However, the driver for the consolidation should not be only the increase of assets. As we have seen from international M&A transactions, in the asset management industry, not all acquisitions result in an increase of assets under management. Actually, on the opposite, some of these transactions resulted in a reduction in assets under management. So the driver for consolidation should be that you add a new dimension to your business, that you expand. For example, in SICO, we are looking at expanding into Saudi. We are contemplating a transaction where we are acquiring an established asset management business in Saudi, and we are looking forward for this challenge. And we have started that transaction during the pandemic. So to just sum it up, I think there will be winners and losers. And in the asset management industry, those who will be able to tweak their strategy and their business model will be able to basically attract more AUMs, and not any AUMs, quality AUMs, as clients at the end of the day need better outcomes at better prices. So if you are able to deliver that, for sure you are going to get out of this crisis stronger.
Well, Najla, thank you so much for that overview. Before we hand over to Nishit, just one question. I mean, certainly at this time, investors are looking more closely at the asset managers they're working with. Are they delivering true alpha? Are they just giving them beta exposure? How's their relative performance been compared to the market? What is your perspective on passive versus active managers in this region?
Thank you, Zachary. To be honest, the data and the GCC shows that actually active management adds a lot of value because relatively these markets are still inefficient. They are dominated by retail investors who invest directly into these markets or through active mutual funds, local mutual funds. But if we look at the ETF space in the GCC, most of the ETFs in the GCC are either small in size or they are small, and also liquidity is not there. So if you look at the largest market, Saudi Arabia, we have 6 ETFs in Saudi. 2 are broad market ETFs, however, they are small. And the 4 others are one sectorial, looking at petrochem, and the 3 left are in gold and government sukuk. So basically, the big ETFs investing in the GCC are not based out of the GCC. They are from outside the GCC, and they're not attracting GCC investors. They are attracting non-GCC investors. So we are still behind in terms of the evolution of passive products. That does not mean that some of the asset managers in the region do not offer passive strategies. They do for institutional investors. But even those, if you compare the performance to the active, you will see that the active will still be outperforming on any investment cycle. And they are outperforming by a huge margin. So at gross level, at net level, they are still outperforming. So a fundamental research driven investment strategy is very much needed in these markets, and not only in equities, even in the fixed income. So in the fixed income at this time, you need credit research and you need active management to be able to navigate through this crisis. As you know, if you invest in high yield and credit with the expectation of higher defaults, you need to be very careful and cautious. So I think there's a long way to go, and I would put my money in active management.
100%. I couldn't agree with you more. And I think that this crisis actually highlighted the outperformance that active managers are able to generate as markets tended to correct so broadly without differentiating between the winners and losers from the crisis. So certainly thank you for that overview. There are so many questions coming through on the Q&A. Please keep the questions coming. Before we're able to go over to the Q&A though, we are going to be having a presentation by Mr. Nishit Lakhotia, who is the head of research at SICO. He has nearly 16 of experience in the field of investment research, risk management, hedge funds, and private equity. He's been involved in sell-side research at SICO since 2009, actively covering sectors such as telecommunications, consumers, aviation, and construction across the GCC. He's a chartered financial analyst and a chartered alternative investment analyst, CFA, and Kai holder. Nishit, I understand that you have a presentation for us. We're really looking forward to looking through that, and hope that we'll be able to share that with the audience after the session as well.
Sure. Thank you so much, Zachary. I'll please share my screen. Yes, we would be presenting on the GCC markets, our insights, what we think the markets are going through currently, from mainly from macro perspective, and also how that has impacted all the sectors in the region, and how they are looking, and whether there are any investment themes that one can play within the GCC markets. So, as one can see that GCC markets have been negative on a year-to-date basis. Most of the markets are down, and all the major markets, despite pulling up from the March declines, like has been the case across the globe, we see that most of the GCC markets are underperforming. And it's not surprising, actually, given that there is a double whammy in this region of oil prices going down, as well as the economic impact from the lockdown and closure that has rocked the entire world. So you see GCC markets, S&P GCC, 15% down currently versus the emerging market, MSCI emerging at 5%. Even the foreigners, when they look at the region, has been actually on the selling side, except some inflows. If you look in Tarawul that have happened this year because of the FTSE last tranche inclusion, we've seen foreigners also being on the net selling side in this region after getting into the region last year. So that's again has been a theme that has been playing out, where we've seen the pressure from the foreigners also on the selling. So let's look at how the macros have moved within the region, along with how the COVID crisis have moved. Uh, when you look at what has happened, GCC governments, most of the GCC governments have been very proactive in supporting the nationals, in some cases even expats, in terms of wage support given to the private sectors. There has been freezing of a lot of fees, deferral of taxes, some levies. So the government has been proactive since the March, April lockdown, in order to ensure that the impact on the business community is minimized. The central banks have been proactive in terms of boosting the liquidity in the banking sector. Loans have been deferred, especially to the SME sector. In some countries, loans have been deferred to of the individuals, as well as the corporate sector, and even interest on interest have been waived. So the measures have actually helped right through the current crisis, and it's continuing. In fact, what we are seeing now in the second phase, as the economy is opening up, there is still a support, especially to the affected sectors. Obviously, this crisis has meant that certain sectors have been affected much more than a few other sectors. So the likes of hospitality, travel, tourism, airlines. So there's some measures that are being now focused on the sectors that are more affected than in general. As one can see, the region was anyways expected to be in fiscal deficit. But then now the numbers are all over the place in terms of the amount of deficit that can happen within the region. Saudi Arabia deficit could easily be double than what they were projecting earlier this year. Similarly, Kuwait and other countries, in fact, all the countries would be having more or less a deficit at these levels. The break-even price, as one can see, where Brent is, most of the countries' break-even is much higher. Plus, your revenues have reduced. Even the non-oil revenues is much lower now, thanks to the deferrals on the fees that we have seen. So, as one can see, non-oil revenue is a big chunk of, or becoming much bigger as the region has diversified. But then what has happened with this crisis, there is a correlation. Not just the oil revenues have gone down, but non-oil revenue also have been impacted with the government lending of support and waiving of fees in many instances. And Dubai has been impacted, though the non-oil revenue is big chunk. Dubai has seen a huge impact from the travel and tourism hit on most of its businesses. As one can see in the next slide, the region has been very proactive in raising debt. In last few months, we've seen Saudi Arabia, Qatar, Abu Dhabi have been tapping the market at attractive rates, and it makes sense to raise money in order to pump up the liquidity within the system, within the economy. Kuwait has not been able to raise because of their issues with the debt law. So they've been drawing on their reserves. But once that is sorted, I think they will also come back in the market to raise money from, and they can easily comfortably raise it given their solid macros in terms of the balance sheet strength. But otherwise, this region, if you look at it, the debt to GDP is still, there is quite a headroom for most of the bigger economies to leverage. Dubai's debt to GDP looks low, but if you add the GREs, then the debt to GDP of Dubai is very high. But otherwise, you're seeing most of the countries, maybe perhaps Bahrain and Oman has on the higher side, but Qatar and all can still easily raise if they want to tap the market. As with most of the global economies, IMF is coming up with the negative numbers, and it's just obvious that the region will go through a recession and negative growth this year, and there will be some level of pullback next year. We'll have to see the level of pullback. Right now, the situation is very fluid, and I think these numbers will keep changing. But one point being made that this year is more or less a write-off in terms of the growth. It has to be negative, and hopefully some normalization we'll see towards next year. Saudi Arabia, interestingly, has been very proactive in taking on many measures. They have cut down on certain capital budget projects and have moved to healthcare allocation, reducing OPEX. They've also taken some measures like increasing VAT over the next to 15%, discontinuing cost of living, and trying to cut down on certain expenses. So there has been support given to the affected sectors, but at the same time, they are using this crisis as an opportunity to further diversify revenues by increasing taxes and reducing some grants. So this will be like a double-edged sword. It is generally long-term good, but it can have near-term repercussion on certain sectors that we can discuss in the coming slides. One of the most important factors to look at is crude oil and its fundamentals. How oil has been, how is oil moving? Obviously, it's been extremely volatile as a commodity. We've got some extreme swings with, in fact, WTI going negative, which maybe nobody could have foreseen before. But obviously, with the entire world being shut, it's a crisis like never before, and oil demand has gone through its own swings. But we are seeing some level of recovery in oil demand over the next few quarters. It may not be anywhere close to what it was last year, but the demand recovery could be pretty sharp in the second half if we assume the lockdowns are removed and economies are coming back slowly to normal. But there'll be certain sectors such as aviation, gasoline, transportation, which will still be far lower than what the normal world was in 2019. But one thing which is interesting to see is that OPEC Plus has come back as the lead group of countries to manage the oil and demand supply, and they've very actively reduced and have a program where they want to reduce the oil supply and then slowly increase the production over the next coming quarters. And this has led to a lot of confidence coming back in the market, and Brent coming back above $40 with the collaboration within the OPEC Plus. But again, there are some countries which is a bit of a issue there in terms of compliance. We've seen Iraq and Nigeria, possibly even Angola. The compliance has not been up to the mark, so it could be better. And this is a risk in case they don't really comply and the agreement falls apart because of lack of compliance. That's one risk that we see. Eventually, we expect one thing which is very important to notice is that the capex has gone down for most of the large oil and gas upstream companies, and this will really have an impact in the medium term on the amount of production and supply that comes in next 2 years. And given the short life of shale in terms of well, we see shale supply going down over the next few years. And even if demand supply is not really in favor a lot to oil, the supply from shale side would reduce, and possibly the market share of OPEC and the region here can further improve. And one can see from a slide down on the right hand side, at what level is the break-even price for shale. It's the for existing well is around 30, but if you want to drill new wells, it's close to $50, and which is where the prices are not there right now. And as one can see over the years, they have been more shale oil and gas companies have been cash flow negative. So it doesn't really make a strong case for them to continue to pump in a lot of capex at current levels. So either the oil prices will move up and then the shale production or investments will increase, or you will see the market share of OPEC producers, which can still increase the output where with relatively ease come into play. In terms of bankruptcy as well, we've seen a huge increase in bankruptcies over the years. So from 2018, 165 bankruptcies to 230 currently, and it will just go up as oil prices remain at levels which is not really sustainable for the shale industry. And as you can see, the OPEC production, the market share has fallen till 2020, because of their supply cut agreement. I think this is where I think it will bottom out and we'll see the market share of the OPEC producers now going up. And it was one thing that was interesting to see this year was the Arab Light discounting, the aggressive discounting that we saw by Saudi Arabia. Arab Light is their oil benchmark. And they discounted heavily in Northwestern Europe and Asia, because these were the markets that they wanted to capture and gain market share when there was literally an oil price war, when the OPEC producers agreement fell apart briefly. So eventually what we believe is that oil prices there is a bullish case in oil price. It will go up, but we are not saying that it will spike to say 55 or 60, but there is a case where the oil prices in the medium term would trend up. But one thing that we have to still be a bit concerned about is the inventory levels. The inventory levels are way above the 5-year average, and especially in US, and this is a concern. So there won't be a spike in oil prices. There is a lot of oil in the market, and the demand recovery will only be slowly. This year we will have a surplus anyways. So coming next to the sectoral outlook and themes, the first is on the banks. Banks have been in a perfect storm within the region. Their NIMs have been declining. Fed has cut multiple times aggressively this year thanks to the crisis. So accordingly, the region here has now follows Fed, given the peg currency. Their monetary policy is similar to what the Fed does, and we've seen the NIMs getting compressed. And we will see that as a theme across the region, but we'll see more compression in the UAE banks. And within Qatar, also the funding costs would rise. So possibly NIMs will come under pressure within the region, across the region. One thing that would possibly revive the bank or would work in their favor is then the government kickstarting the economy. We are seeing government borrowing to, not just protect the sectors, but also to encourage revival of demand. So we believe banks which are focused towards public sector would do better than the ones focusing on other segments. And government will be the one that will be leading the recovery slowly and steadily from second half to next year. One theme that is continuing in the banking space is the consolidation. It has started now in last few years. We've seen some recent M&As that has happened within Saudi Arabia, UAE, even in other countries, Bahrain, Kuwait, Qatar, and these M&As have been done mainly to cut costs, become bigger size, and bring in more synergies. I think this is a theme that is natural to expect when the overall industry is not growing, and the only way to protect earnings is to manage your costs. And something that is happening as we speak, where within the region, with NCB Samba recently announcing their merger, AUB KFH continuing since last year, and there were a few more M&As happening or expected to happen in Saudi Arabia as per the governor. So this is a theme that will continue. Possibly investors have to look at which banks can benefit the most in terms of their operating expenses and scope for synergies coming out of this consolidation theme. In terms of asset quality, again, this is a concern for the banks across the world and also for the region. But if you look at the asset quality of the Saudi banking space, the Saudi banks have decent asset quality, strong capital position, and their NPL ratios are very low. So, and they also have limited or modest rather loan loss reserve buffer to cover for future losses. So overall, Saudi banks are relatively comfortably placed compared to, say, UAE, which is seeing a lot of stress in asset quality because of some major companies going bankrupt or under administration, such as NMC Health. And we've seen a good exposure of many of the banks there. So the asset quality in UAE banks are much weaker currently. In Qatar, it's been the smaller Qatari banks that we've seen that we see as risk because of the delinquencies that one may get in the real estate and construction sector. Otherwise, the banks are relatively okay. They're faring better, especially in the Sharia compliance space. While in Kuwait, there is a decent headroom in terms of loan loss reserves. So we are not really a lot concerned with in the Kuwaiti banking space. Now, outside of banks and building materials, within Saudi, one theme that is strong that we are also optimistic is on the housing. Housing theme continues to be doing well. It's a theme that's going on since last 1 to 2 years, and it's a Vision 2030, one of the key pillars in terms of increasing housing coverage. Although cement, between how to play this theme between cement and ceramic tiles, we are seeing cement players within Saudi Arabia benefiting, but not to that extent as much as ceramic. So ceramic can be a good play in the Saudi building material space. While in cement, we are more optimistic on cement companies in the Western region, as we expect demand there to improve in the coming quarters with increase in housing projects coming on that side of the country. But again, the risk to this would be austerity and degrowth of population with exodus. Another interesting thing is the feedstock pricing in the region. Now we have the feedstock prices are generally fixed in the region, and this was fixed at a lower, generally it's at a lower level, and versus the benchmark Henry Hub gas and other prices historically. But now if you see, all the prices have fallen so much that some of these pricing benchmark is actually lower than the current region's prices, especially for Bahrain. So that might make the situation uncompetitive. But in Saudi, there is still a gap within this, and perhaps this can be a good time for removing the fuel subsidies and make it market linked. The only downside to that would be, although the product prices will follow that, but the only downside to that is that the supernormal profits that some of them will make will not be able to. But at least it might be a good time for some fuel subsidy reforms to be done, given the prices where it is currently. But in overall, if you look at the demand side, global manufacturing, it is still contracting, though the rate of contraction has declined. But we are not really seeing a huge jump right now in the demand. So we are a bit cautious on the building materials and all in terms of the pricing for the commodities. The demand is recovering, but it will take some time. I mean, IMF is also expecting some recovery next year. But I think there's a lot of assumptions here in terms of how the economy will kickstart. But even if you go by IMF owns growth assumptions, the level at which the developed economies would be much lower than where they were in 2019 and 2021. So it is still far away from new normal even in next year. in the petrochem space, again, we are negative generally for the petrochemicals. Maybe some high yielding names are the ones that one can look at, but there is a lot of supply coming in both in the PE and propylene space, in PE within US and China, and in propylene in China. So you will see the operating rates being low. Perhaps the growth would be mainly coming because of improvement in the oil prices, on the price front, on the product prices. But if you look at the valuations going forward, it's not cheap. The sector is expensive. Yields are falling, P's are very high, so it's you have to be extremely picky on this sector. And aluminum is another metal that matters to some of the listed names here. We are again negative on this, though the production of primary producers have been very strong. It is mainly because of the demand from the bankers who are buying this stock and keeping it, but not from the industry. So the demand overall has not really needs to recover a lot because the production has not really fallen. Inventory levels have already gone up, and we believe that the off-exchange inventory must be much higher right now. So there is a risk there. Everyone is playing the contango currently, but the prices can actually go down in the coming months. So we are negative on the aluminum industry. In terms of reality space, not much to talk about from a macro perspective. We are seeing a lot of supply, demand destruction, especially in the UAE. And perhaps one theme that will be the work from home and maybe demand for larger spaces in residential space. Maybe villas, for example, there has been some companies in UAE which have done some decent villa sales recently. So maybe that is a new trend to watch. But if you look at overall real estate space, we don't think there is a lot to play. Although the companies that are listed, especially in UAE, they have some strong balance sheets and there are some names that are offering dividends. So maybe that makes a different sense, but the macros are not really strong. Even the mall retail is going through a structural impact. And a lot of them are going through omni-channel retailing, e-commerce as one way of increasing your sales. But this is an impact that we are worried about in the region. Even the hospitality, until the tourism and travel and tourism come back to the levels which you don't see right now, there are efforts being made. Dubai has a good promotional campaign, but we have to wait and watch whether people are actually going back and holidaying and business travel coming back to normal, which we are still very far. But e-commerce is a clear winner. There are some names that one can play with that, but other than that, not a great theme here. And as one can see, despite the opening up, the economy is still pretty slow in UAE. It is not really coming back from an external point of view, though the normalization is happening within the country in terms of their own residents, in terms of opening up. Healthcare has actually done well in Saudi Arabia, and it's a VAT-free sector, which is an important thing to note. So the VAT increase is not going to directly impact the healthcare sector. And there has been an increase in the demand in the because of COVID. There is going to be second quarter might be good, but the sector has rallied. It's done actually one of the better performing sectors. So it's rich. There is a lot of expansion happening within the sectors, but it's not something that is, it's not a value play. So a lot of it is priced in within the healthcare sector in Saudi Arabia. Airlines is one sector that has seen the maximum impact on their structural or long-term fundamentals. We have only two names within the region that is in the listed space, and they are competing with the state-owned airlines, which have flying a huge, literally the likes of A380s. So it's going to be a really tough next 1-2 years. Initially, there is a lot of repatriation flights going on. There is a lot of pent-up demand because of people being stuck in different countries and they want to travel. But once things normalize, we'll have to see whether the business demand, leisure demand will come back in space. Actually, when such a structural impact happens, you need to have some bankruptcies or you need to see a huge decline in the fleet. But here, most of the airlines in this region are owned by the government. So they can always come back with their supply, and in terms of traffic rise, protectionism and all, it can be a risk that we see on the airlines. The only comforting factor is both the listed space here, the airlines are good balance sheet. Telecoms technically should have benefited in this crisis, but we haven't really seen a huge benefit coming to the telecoms currently because they've not been able to monetize most of their, in terms of the data increase. They've given some free packages. So although their impact is relatively lesser than the other sectors, we are not really seeing a huge growth in telecom. I think one of the plays would be the companies which have strong balance sheet and are able to meet their dividend commitments are the ones that will do better. But otherwise, in terms of earnings or bottom line growth, you will hardly find many companies going through that because of the other macros actually hurting the sector more than the benefit from the increase in data. So what will be interesting to see is whether they will be able to monetize 5G investments and charge more and push people to more take better packages. And another interesting thing that is happening, especially in UAE and all, is the voice revenues have been hit because everyone is using the likes of Zoom, Microsoft Teams, and not really making any international calls directly. And staples in consumers have actually done well. Obviously, you're not spending a lot on restaurants and other discretionary aspects. So you will staying at home. One segment that is really benefiting is the beverage and food. E-commerce is really helping companies like Jareer, Extra, in the listed space have really done well in terms of boosting the e-commerce sales. So even despite shutdowns, they've done really well. But other aspects like gym, cinema, and other travel and tourism companies, that is where we see a bit more of impact. Again, VAT is coming in Saudi, so the companies listed there on discretionary side will see macro weakness, and expat exodus that can happen. That will be another thing to watch. So finally, the things that will very matter in this region in the next second half would be first on the COVID cases. Like in most of the across the globe, we'll have to see the active COVID cases in GCC have seen a sharp fall. Whether the economy can normalize quickly, whether we'll have a second wave or not, and how the vaccine. So there are a lot of questions here. It will affect the globe as well as the GCC. We all are in the same boat here, more or less. Expat exodus, this is a theme risk that we've seen even in the past, and we would it will have a second degree effect on the real estate, telecoms, consumer. This affects a lot of sectors. So how that will how significant would this be, and what impact will it have within the sectors? And Saudi Arabia has been doing a lot of things. In last 6 months, they've been very active. They've increased the VAT to 15%. They've cut the cost of living allowance. They are even cutting the number of people under citizens account eligible. So this is going to impact the discretionary spending, both for expats and for Saudi nationals. So this is something that we'll have to wait and watch whether how bad the impact is on the consumer side, and also what the government stance is from next year on the mega projects that is continuing in Saudi Arabia, the likes of Red Sea, Neom, Al Qiddiya, what is happening on that front, how the tourism is, how good the domestic tourism jump would be with people not traveling. Are they using domestic tourism as one way of exploring, and that sector can actually see some growth from here. Also, whether in this region we'll have more of direct taxes. This is a question that everyone keeps asking. And when you have a huge fiscal deficit, this is one part where we'll have to see whether there's more reforms there. Long-term visas, we've already seen in the past how UAE and Saudi Arabia have done in terms of green cards or long-term residency visas. Such reforms will it continue? Fuel subsidy, like we spoke about earlier. Yeah, Saudi Arabia is introducing derivatives by this next month end, and I think which is a very important capital market reform where this was much needed. And being the most liquid market in the region, this is going to be a very interesting and additional option to the investors looking at this region. And we are also seeing a lot of IPOs in the pipeline, especially in Saudi Arabia. We've seen few IPOs in the first half, which have done very well, and given the situation as well. So this is an interesting segment, and it is good to see that IPO activity is still continuing. It's not dried up. And one more thing that I would like to tell users is this region is a oil beta play. So when you're looking at emerging market, and this region is now under emerging market bucket, this is, if we are bullish or we expect oil markets to recover from here and go up, this is an interesting way of playing the region by being long on the region. And also the fact that they have strong balance sheet and a lot of scope to leverage, and they've also already done that initially this year, and they will plan to do that in the coming quarters. Thank you. With that, I'll end my presentation. I'll leave up for the Q&A. Thank you.
Thank you, Nishit, for an incredibly informative presentation. We have so many questions coming through on the Q&A. We will address as many of those as we can, but with how many questions have come in, it's just not going to be possible to address them all. Many of you have asked whether you'll be able to have a copy of the slides. We were able to confirm with Nishit and Najla's team that they will indeed be distributing slides to everyone. So you'll be receiving those in your inbox very, very soon. One of the, you've highlighted the different factors, the different themes that we need to take account of. The fact that there are winners and there are losers in this COVID environment. And even amongst the losers, there are those that are losing less and those that are losing more, suffering a greater impact and a lesser impact. This has made it more important for asset managers, for investors to differentiate, to be able to pick the winners, to underweight the losers and those that will be most dramatically impacted, and extract alpha from the markets. And has certainly highlighted the importance of firms that are driven by research, that understand the impacts, that are analyzing it, like SICO. I'd like to understand, Najla, one of the points that you've highlighted, and actually there's several questions on the Q&A regarding this, is the importance of communicating with clients. This is something that asset managers need to do more so in times of crisis, so the clients understand what's happening. They understand what their asset manager is doing to protect and grow their assets. We'd like there's several questions to understand how you have communicated with your clients, how you recommend asset managers communicate with their clients, like we're doing today. This is Zoom webinars. These have become part of the theme, but what else besides these new communication platforms are you using to help communicate with your clients and help them understand how you are protecting and growing their assets?
So I'll try to keep my answers very short. In terms of the mode of communication is simply telephone calls, Zoom or team meetings. We try to reach to our clients and give them an insight into the strategy going forward, what themes we are looking at, and how we can limit the downside on the performance and maintain outperformance. So that was the key topic in all our discussions, and see if the clients have any urgent needs for liquidity. So we make sure that the portfolio composition is liquid enough, even in turbulent markets.
And understanding clients' needs, understanding their preferences is certainly critical. Issa Khalifa has asked, and I think this would be a question for Nishit, but Najla, if you'd like to answer as well. How do you believe the downturn caused by the pandemic has affected investors' preferences and appetite? Would they revert to their traditional investment preferences, or has the crisis changed their investment criteria? Nishit, maybe if you could give us an overview, and Najla, if you'd like to add to that as well.
Well, in terms of the crisis, yes, I mean, this crisis has affected different sectors in a different way. But thanks to the crisis, even by asset class, if you look at it, because of the crisis, there's been so much of the Fed rate cuts, the way the treasuries are, right now, if I was an investor and I'm looking at fixed income perhaps space, I really don't have a lot of returns. So I would say this crisis, equities as an asset class is looking relatively more attractive. And at the same time, the required return that one expects from these asset class has also reduced. So you would be happy with say 7% return in an equity versus 9% previously, maybe 10%. So so that way there has been one aspect where things have changed, and within this, obviously this crisis has benefited certain sectors, has impacted negatively certain sectors. So where you have to be extremely, like we said, it's been, you have to be active as an investor and be in the right sectors and identify gaps. So we've seen that investors are willing to pay much more premium into companies that are still growing or benefiting. So, for example, a grocery and retail company growing at 8% earlier might be trading at say 20 times P, but now investors are willing to pay 25 to 30 times P for that growth. So because they want certainty. Plus, at the same time, a 5% yielding company earlier was, or 4.5, 5% was not looked at a very attractive dividend yield. But now this is actually a decent yield that investors are willing to take, given that there's hardly any return on the other asset classes. And if you're guaranteed that dividend yield, you will surely take that as an investment into your books.
And Najla, how are you seeing investors' preferences shifting in response to the downturn?
Of course, during this crisis, we have seen markets fall very steeply in a matter of days, and then rebound and recover in different parts of the world with different speed. However, I think that investors are looking at liquid yielding assets, and whatever asset class they are looking at, they will demand liquidity. So even when it comes to real estate, which is traditionally an asset class that is preferred, very much preferred by investors from the region, I think the appetite for real estate will be reduced going forward, even though the rates are low. However, liquidity is an issue, and we are seeing that real estate market is quite illiquid in many countries within the region.
Yeah, and the flight to liquidity, the flight to quality has certainly been a key differentiator in terms of performance. Nishit, you were discussing that, how that flight to quality has been affecting valuations, and a question from Shirish Rout has been to have an understanding of your house view on the valuation of regional markets, particularly in comparison to other emerging markets. We've seen that this region has lagged other emerging markets in the recovery, particularly with China driving emerging markets index to very strong levels. How do you see valuations of this region now as compared to the rest of the emerging markets index?
Well, this region, I would not say that this region is cheap, despite the underperformance. There are certain sectors that looks fully priced in. But at the same time, what we think within the region, like for example, we like UAE, despite the headwinds, there are certain names that have very strong balance sheet and they can survive the crisis. And I think that that's where one should focus on in terms of leverage at the company level. And there are names that can give you a decent high yield. So yes, there are certain countries which look attractive, but there are some countries, even if we think Saudi Arabia is not really cheap from here. I mean, it's more or less priced in, but there are certain sectors within Saudi Arabia that looks good. But at the same time, like we said, we are negative a bit on the petrochemicals. So petrochemicals will not be one of the biggest weights in the index. So we have to be very careful of getting into that sector, and rather than play with names that within that sector that has decent maybe yield. So it has to be extremely picky. Overall, the region is not cheap, and you have to you have some spots, some bottom of fishing more than taking a macro view on the country currently.
We still have almost 40 questions in the Q&A. We only have 5 minutes left. Of course, we're not going to be able to get to them all. For those of you who have submitted questions, if you submitted it with your name instead of an anonymous question, we will do our best to try to address questions after the seminar. Nishit, you and both Najla have discussed liquidity in the regional markets. How has liquidity been affected? We've seen several years of continuing kind of diminishment of liquidity in certain markets in the region. How has COVID affected liquidity of listed equities?
Okay, in terms of liquidity, there are certain markets that are more liquid over the last couple of years, and they still continue to be, like Kuwait has seen a good increase in liquidity. Liquidity in Saudi is more or less similar, not really grown, but yes, with the addition of Aramco, we are seeing a bit more overall turnover in the market. But liquidity is generally an issue within the region. UAE liquidity has been very less, and it's a concern. So we need possibly measures done at the regional level to boost the liquidity further. I think liquidity could be much better, and a lot of the large institutions, be it in region as well as the qualified institutions outside, they take liquidity as one of the important criteria before investing in any stock. And a lot of these stocks, even if they're good quality names, and even if what we want to recommend to our clients, at times we see that it's not really that liquid. And so it's not, we've not seen a big change in the liquidity because of COVID. It's been almost similar, but liquidity has been generally an issue in the region in the last few years, except Kuwait. Kuwait has seen some good pullback in liquidity.
So we've discussed, we've had a lot of discussions around equities. There are several questions in the Q&A. I will select Yusuf Booz for now, but there are several others that have asked about your view on GCC government and corporate bonds now going forward. Do you believe that these offer robust downside protection and liquidity for investors during downturns versus a yield play? What is the house view on the corporate bonds in Sukuk and government?
Okay.
So I'll take this question. In terms of fixed income, of course, we had a sweet spot in the fixed income GCC government and quasi-government bonds at a certain point of time. I think late March was a good time to buy into these bonds. However, what we have seen is that the recovery has been very strong on a very low liquidity. So I think with an ease on the lockdown and economies started to open up, people had regained confidence and started buying anything that gives a yield that is higher than 4%. So at one point of time, some of the government bonds issued by the government of Oman or Kingdom of Bahrain, 10 years was around 6 to 6.5. It declined to around 5%. So you can see that, with 150 basis point of yield contraction, the demand is certainly there. Is there value there? There is value in some high yield names. However, as I said, credit research is very important. And at the end of the day, if you are comfortable with the risk of taking GCC exposure, then certainly you are comfortable with some of the high yielders in the GCC.
Excellent, thank you. I hope you don't mind can I ask you both if we can go 5 minutes over time so that we can try to clear out some more of the questions, because there are great questions coming in from the audience. So now I understand that typically during these webinars, it's very rare that an asset manager like yourselves would be, able to give people kind of stock picks or specific names. But we have several questions from the audience. I think I might as well give it a shot. Do you have any top picks or top names on fixed income or on the equity space that you'd be willing to share with the audience?
Well, I will ask the audience to call our trading desk or just register for our research, the daily research, and also our topics on the equity. However, maybe Nishit would like to share a few names because his top list is sent to clients, and maybe we can give some value to our participants today, Nishit.
Yeah, sure. So yes, we have names within the region across countries. So, for example, like we talked about some themes within Saudi Arabia. So, within the export-driven sectors, one name that we like right now is Mardin. Mardin is a good name to bet on a long term. In the consolidation side, Samba is a bank that we recommend within Saudi Arabia. Again, we've been bull on the banks in UAE on the Dubai banks. So ENBD today also is up with the FOL, and it's doing very well. So Emirates NBD is one name that we've been recommending. Aramex in the e-commerce theme is another name that we think will play out well. Bahrain has certain high yielding good name, but they can be a bit illiquid. So it depends on the size of the equipment, size of the investment that we can recommend. But there are names like EPM Terminals here, which is yielding very well. It's a bit illiquid, but it's a good name to hold on, have. Even AUB in banking space here is a solid name to keep. In Kuwait, we have an education play, HumanSoft, that we like. We've been recommending that for a long time, and the stock has done well recently. We still like the name. So yeah, the few that I can just mention here, but the list can go on. So there are names within the region on a bottom up, and every company has its own theme. Even if the macros are not that exciting, some of the companies, the valuations are good. So one can really make good returns even if they enter at these levels.
Well, it's very generous of you to share the names live on the webinar with us today. But I do recommend everybody in the audience, if you're not already subscribed to SICO's research and are not in contact with their desk, definitely get in touch. We'd be happy to put you in touch with the right people from their team to learn more about some of their top picks and the opportunities that they're seeing in the market. One more question for Najla. We've discussed quite extensively traditional asset classes. A question from Mohammed Hamdi is, what's your view on alternative investments after the crisis in this region? And what are some of the promising sectors that would emerge strongly in private and alternative investments?
On the private equity space in this region, we are not, a house that is specialized in this asset class. However, since we follow the market from a macro and micro level, and these are the public markets, we also are informed about the private market. To be honest, there is a lot of value in this region, and I think if someone has the appetite to take risk, should be a well-diversified portfolio. So it's better, my advice is to go through a fund and rather than going on direct investment. In any case, I think most of the opportunities that are coming up are on in parts of the GCC that has more of a promising outlook in terms of diversifying their economy. And I think Saudi for sure stands out.
Absolutely. Thank you so much for taking a deeper dive. Now, actually, one final question. There are several people who've asked about this in the audience. And so one kind of tail risk that a lot of people do see in this region is the risk of a devaluation or a break in the GCC currency pegs to the dollar, given the strong current account deficits and concerns about the outlook of the price of oil. What is your view on the likelihood or potential of currency devaluations in the GCC? Which countries would be most at risk? Which would be at least at risk? Is this something that keeps you up at night?
Okay, should I take it, Najla?
Yes, sure.
Yeah. Okay. In terms of devaluation, I think this is a concern that keeps coming within the region. I mean, it's not the first time we are hearing it. Every time we see the oil prices breach a certain level, there is a concern on the devaluation. One thing one has to understand on this is whether the devaluation will be forced or it will be done voluntarily. And in both sides, let's look at it. Voluntarily, if it devaluation of the peg and all, if it is done, it would be, it has to be done from an economic point of view, whether the country benefits out of this such a devaluation, which if you look at the current import-export, the trade angle and all, it's not really in their favor. And also in terms of the peg, if you look at the borrowing that they've done in dollar and future borrowing, all that can be really at risk, and the future tapping the debt markets can become really difficult. So it will not be done voluntarily, and I think it's many central banks have made it very clear that this is not something that they are considering even remotely. So I don't think it will be done voluntarily. And if we're being forced, I don't really think that is going to be the case, because the balance sheet and the strength of some of the countries are very strong, are very good. And yes, there are some weaker countries in the region, but you see that GCC as such, there is a support to each other's economy. So that implicit and at times even explicit support can be very clear that forcing on one country is not going to be the case, because if it happens to one country, then it can have a ripple effect on the entire region. So both sides, I don't think is going to happen. It didn't happen in the past, despite the speculation. It will not happen as of now.
Well, thank you so much for this insightful session. Again, I wish we had more time. That hour flew by. Thank you for giving us an extra 7 or 8 minutes of your time today. Anyone who has more questions, please, again, get in touch with SICO. They have an amazing team. They'd love to engage and interact with clients. We had so many people join us today. One stage we had close to 300 people live on this session. The asset management industry, as you said, has faced challenges as a result of this crisis. But as a result of this crisis, it's also been an opportunity for those who are able to deliver alpha, to thrive, to outshine, and to demonstrate the value that they deliver to investors. The oil price crash has been a significant impact on the region. We had a very deep dive. Thank you very much, Nishit, for helping us understand the impact of the oil price crash and some of the aspects that are considering your outlook, particularly CapEx, the CapEx pipeline, and continued investments in the space. You discussed some of the other themes and factors that are differentiating the impact between the winners, the losers, the bigger losers, the lesser losers, the bigger winners, the lesser winners, and how that plays into building an investment portfolio. We discussed the flight to quality, the flight to liquidity, the fact that people are willing to pay a premium for the investors are willing to pay a premium for the top assets. We discussed investor preferences. We discussed pretty much every sector: healthcare, construction, cement, banking. So it's really incredible how much we were able to cover today. Telecoms, e-commerce. You shared with us some of your top picks, something that is very rare for a firm to be willing to do on a live webinar. So we really appreciate you sharing those picks and some of your house views. That was extremely helpful. We discussed the impact of the expat exodus, beyond oil, some of the reforms that are happening in the region, and we covered the currency pegs. I really want to thank you so much not only for sponsoring, but for participating in this session. We'd love to have been able to go on longer. Again, I've really taken away a lot from this, and so has the audience. For everyone who's been in the audience, we will send your questions over to the team for further follow-up. If you're joining us after this session on YouTube, the session will be posted on YouTube. The presentation will be shared with everyone who is in the live session. If you're looking at after the fact on YouTube, just email us and we'll be happy to share with you the slides. Please like and subscribe the video and subscribe to our YouTube channel to dial in for more sessions. We do have some very exciting AIM Summit webinars planned and look forward to having you again in the future. But again, thank you so much, Najla. Thank you, Nishit. This has been incredible and a very, very valuable session for those of us who invest in and are exposed to the GCC. Can't thank you enough for your time.